All right. Hello and welcome. My name is Anna Kampanek. I am the Director of Global Programs at the Center for International Private Enterprise, or CIPE. It is my pleasure to host today a second event organized in collaboration between CIPE and Duff Phelps Institute, focused on a very timely and very important topic of the post-pandemic future of ESG investments and capital flows, ESG standing for environmental, social, and governance considerations in those investments. I think we still have some participants trickling in, but in the interest of time, let's get started. As I mentioned, this is the second event in our series. In the first one, we looked more broadly at the current trends in ESG globally, impact of COVID, considerations such as risks and opportunities connected to ESG investments, considerations for the board, trends in metrics for ESG. Today, we will continue that conversation and hope to focus more specifically on one geographic area, Central and Eastern Europe. It is my pleasure to introduce the panelists at today's event, starting with Monique Melis, who is the Duff Phelps Institute Fellow and also Global Head of Compliance and Regulatory Consulting in Duff Phelps, and also Dr. Efraim Chalamish, Duff Phelps Institute Fellow and Senior Advisor, who kindly, for the purposes of this webinar, I think will allow us to address him less formally as Effie. Welcome. And last but not least, my colleague at CIPE, who is the Deputy Director for Europe and Eurasia, Hontz. It is a pleasure to have you all here. I will not go deeper into everybody's illustrious career and experience in the interest of time. Our audience can find the links to everybody's bio in the event invitation. We will also post a link in the chat to the initial event, which was recorded, as is this one. So if you have colleagues who are interested in the subject, but either missed the first event or the current one, please make sure to share the links. We will also be sure to leave plenty of time for Q&A. So as our panel progresses, if you have questions, feel free to type them in the Q&A and we'll get to them in due course. All right. Maybe let me start with a general observation, something that I recently read in a biannual report from the US SIS Foundation, which is a forum on sustainable and responsible investment. One of the leading voices advocating for sustainable investments. And according to the numbers that they gathered, the amount of professional money managed using ESG criteria rose sharply in the US and now represents 33 of the over 51 trillion in total US assets. And that represents an over 40% increase over 2018. Climate change continues to be one of the key considerations and top concerns among those investment criteria, accounting for about 2 trillion, according to that survey. And also notably, since that report was first published in 1995, the sustainably invested assets have grown at a compound annual rate of about 14%. So the numbers are telling. ESG definitely is a growing trend in the investment world. And it has been so even prior to the pandemic. But let's delve a little bit deeper into what current trends you all are seeing globally. And then let's see if we can focus our discussion specifically on Europe. So first, let me turn it over to Monique. Could you give us your perspective from Duff Phelps? How do you see the global trends in ESG shaping up, and how does Europe fit in those larger trends?
Well, so at least so I work in financial services regulation, and I'm also on the board of a bank, which is highly regulated by the Prudential Regulatory Authority here in the UK. And from both these, if 30,000 feet positions, I would say I see a lot of investment in ESG. There has been through COVID, we've seen a lot of people talking about it and focusing more on ESG, particularly the environment and diversity. And I wonder if it is because we've had more time to think about things like that. And I just hope and pray that we won't revert to type once this is over and forget about how important it is. I know that the big jurisdictions lead the way through various types of regulations. And I also know that from where I sit, we have a history in regulation of comply or explain. And investors, they expect us to comply or explain. However, I wonder if in some jurisdictions, particularly in the emerging jurisdictions in Europe, they will perhaps quite frankly legislate because the DNA perhaps of companies is different and behavior is different. So I think we will see an evolving trend here.
Wonderful, thank you for this initial thoughts. Let me turn it over to Effie. So I know your specialty is sovereign institutions and investment funds. What are the challenges for public or sovereign financial investors when executing ESG strategies? If you can talk more broadly or in Europe specifically.
Terrific. Thank you very much, Anna and CIPE, Duff Phelps. We really appreciate the partnership and the topic of today. Let me just start and say a few words about what I see now in the market and why public investors, sovereign investors, are becoming such a big players in the world of ESG. For a long time, frankly, when people thought about ESG, they thought about private companies or listed companies. That's kind of the first idea that people have in mind. But actually, one of the most exciting areas of growth in the ESG space, especially in Europe when it comes to public investors and pension fund, is the ESG. So what actually happened here? First of all, over the last couple of years, for the first time, you have a direct investing by pension funds and other public investors directly in markets. And the more they get involved in private markets, sometimes co-investing with other private investors and other private entities, the whole world of ESG is becoming very, very direct. Also, by now, we have enough research to support the ESG role within the public sovereign finance universe. So if in the past we had many studies about correlation between returns, financial performance, and ESG strategies, and many of these studies were conflicting, now we see that many of them show strong correlation, especially with respect to sovereign financial institutions. So I think between better returns, better performance, and the fact that more and more of them are actually very involved in private market and private investing, it means that this is a great opportunity for the public universe. And by the way, and hopefully we'll have more time to speak about other features of the market, just a few words about why I think the characteristics of sovereign financial institutions and entities, they're a great fit for this kind of ESG investing. I mean, think about it. These are very, very large institutions. Monique referred to banks. Many of them are some of kind of the largest financial institutions in the world. They're very well diverse. So if they execute one ESG strategy with one portfolio, it can impact positively another portfolio. They're also diverse geographically. And most importantly, they really represent the voice of a generation or multiple generations. So they really think about how the next couple of generations going to look like. It's not only the next quarter, the next financial year. This is a generation. And over there, I think the reputational risk is so dramatic that frankly, they cannot afford themselves not to invest via the lenses of the ESG.
Wonderful. Thank you so much for that. Let me turn it over to my esteemed colleague, Eric, now. CIPE particular lens on the ESG issues comes from what we call constructive capital and corrosive capital. Could you explain what we mean by that and how does ESG fit into that framework?
Sure. At CIPE, we work a lot in emerging markets with the small and medium-sized, the high-growth business community in those markets. And a few years ago, we've noticed certain trends, and that certain actors were investing in these emerging markets and emerging democracies, and it was undermining institutions of markets and democracies, and other investments were strengthening those. So over the years, the past few years, we've developed this spectrum of investments where we have one side is more corrosive in nature, where they don't strengthen the institutions and in fact do undermine those institutions that are emerging in these new markets. On the other side, there are constructive investments, and these are a lot of those that are affiliated with those principles followed by ESG investments. That is, managing to, they used to call it the triple bottom line, where you're not just taking financial considerations into respect, but also these other external conditions. If I've heard two phrases or two words repeated ad nauseum while we're in COVID, it's resilience and sustainability. And these are the buzzwords that you read in the financial press. And I think what the studies have shown is that ESG does offer those two things. When you're not measuring everything in terms of a financial output or a financial metric, when you're measuring your environmental footprint, your social footprint as well, you build into your business a measure of resilience and sustainability.
All right, excellent. Well, let me pick up on some threads that you all already mentioned. Monique, if I can go back to you. So you mentioned that one of the trends or one of the developments you're seeing is still a lot of focus on the environmental side of things in ESG, but also some evolving focus on other issues like diversity. Also, I think we've been seeing, because of COVID in general, there's a greater emphasis on the S in ESG, the social, to sort of how are companies behaving responsibly to provide health and safety to their employees, to help bolster the resilience of communities, to bring back the term that Eric just mentioned. Could you elaborate a little bit on that? What developments do you see in the S part of ESG, or maybe also in G, in the governance side of those indicators?
So if I go back to the regulators, there has been a lot less focus in the last couple of months, at least, or last 6 months perhaps, through COVID, on pure profitability, to pick up on Eric's point, and much more on what is our role in society and what can we do better and what should we do better. And the regulators are really focused on the tone from the top and setting the right governance structure within particularly the banks. And if I talk about banks, just aside from other financial institutions, to me, exactly what Effie just said earlier is that they have such an important footprint in the world. They are so big that they're like little countries, and they're almost like little countries that span over borders. So they're extremely important in their agenda and how they execute their agenda. And that's why I think regulators, they focus so much on tone from the top, on the E, because they're responsible for a lot of lending. So they actually have an impact there for generations. On the social aspect, in terms of not only the well-being of their own staff, but actually how do they bring diversity into the boards, and how do they bring diversity into the senior management and leadership roles. And I know from where I'm sitting that that's something we have focused as a listed bank a lot on in the last 6 months or even 8 months and longer. So we have a responsibility as senior people to work that out and do it properly. And I think that is the expectations of the regulators. But what I also know is that sadly, nothing changes unless the regulatory bodies of the world and the investors of the world push. So it doesn't just come by itself. And I think we can see that otherwise, why would not all countries behave responsibly and with sustainability? They don't. So it's maybe in human nature you have to be pushed a little along in order to behave properly.
Definitely, that's we can see that in many instances. And also, if I may go back to what you talked about earlier in terms of larger jurisdictions leading the way, let's bring the conversation back to Central and Eastern Europe. How would you evaluate the situation there? And so do you see, even if those countries in the region may not lead, to what extent do they follow? What challenges do you see there, given that obviously financial markets and the culture of investing in that part of the world is much newer than in more established markets?
Yeah, they have a real challenge getting it right, and it is important that they get it right. It's important for the DNA of the financial system in the world that these countries also come along. They often have the same regulatory framework, which is the overarching directives that we have in Europe in MiFID and UCITS and the AFMD and so on. Big directives that govern us all, but they don't have the experience and they don't have the history in financial services regulation in the same way that we perhaps do in the UK or in some of the more Western countries. Now, interestingly, we're pitching for a piece of work in one of the Eastern countries, which is funded by the Swiss government and overseen by the World Bank. So it goes to show that it is an interest, or we're taking interest from the more developed markets as well, to develop capital markets and proper functioning capital markets in the Eastern jurisdictions. They have a huge opportunity to grasp it and run with it. And there's a lot of skills, but perhaps not so much experience in some of the countries. But I know, for example, some of the banks now and even professional services firms, they use Poland a lot, they use Bulgaria a lot, they use, they use these hubs for money laundering, anti-money laundering controls and so on. So they are learning and coming along, but they have to understand why they're doing it. And I think we have a role to play there to help.
Thank you so much. And Effie, back to you. So I think you mentioned something, well, several very interesting threads, so we can pull on a couple of them. So one is this, ongoing debate between, or maybe it's a false dichotomy, but there's a debate whether or not focusing on ESG somehow detracts from focus purely on financial performance, or is it a complement, or does it depend? It sounds like you have seen studies showing correlation, and definitely in the longer term. So that I would be very curious to hear more about that. And also speaking of longer term, I think you mentioned it's almost out of a generational perspective that especially larger investors, sovereign investors can take. But also I think there's the other side to it, which is evolving expectations also of smaller investors and consumers who also have, especially the millennial generation, may have a longer term perspective and value, caring for environment or other aspects of responsible investing. Could you expand a little bit on those two themes?
Sure. And I think at the end of the day, everything is connected to each other. So for example, Monique mentioned the fact that many different parts of the ESG story is still under-regulated, and regulators are still trying to find a way to show the way, whether we're talking about data and quantifying factors or reporting requirements. And that's exactly what we're talking about, because some parts of the market, Anna, are still under-regulated. It actually, as a positive force, it forces governments, companies, pan-European institutions in the context of the European discussion of the day to be creative and to find a way to bring different pieces together, to think how to bridge the gap between short-term savers to long-term impact on the market, how to bring the public and private investors together, how to bring Western Europe to Eastern Europe, some of the jurisdictions were mentioned. And I would like to give a couple of examples to make it a little bit more concrete. So for example, there is a fund called Magritte 1, Magritte 2, based on the success of the first one. It started as a venture by the European Investment Bank in order to bring a couple of public sovereign financial institutions together in order to invest in long-term projects all over Europe, especially Central and Eastern Europe. And the idea was to bridge the gap in financing and funding and to bring funding for these projects. Many of the what you call small savers are part of some of these pension institutions, but at the same time, the projects are very, very large. Like, for example, a subsea cable for communication from Portugal all the way to Latin America, or for example, natural gas distribution network in Latvia, or for example, wind farms and energy from West projects in Poland. So these are exciting, big projects which are going to change the continent forever from Central to Eastern Europe. And the most exciting thing here, if you look at the sponsors profile, you have the Polish Development Bank, like the Swiss example before, one of the sponsors of the fund. In other words, there is a great way how to create ESG mentality or culture in Eastern Europe, even just by creating a traditional investment vehicle in Western Europe or with the European financial institutions in places like Brussels. Another example is the local and regional stock exchanges. So if you look at Eastern Europe, Central and Eastern Europe now, so you see places like Warsaw and Prague, kind of the large stock exchange in the region, although it's true that there is still a way to go with respect of the information gap, but the reality is that they are becoming more and more sophisticated over time. And if you look at the trend globally from the Middle East after the Abraham Accord, or the move of Chinese companies to list locally and other Asian companies to list locally in China instead of going to the other side of the world in the States, it means that companies, especially SMEs, are actually looking for ways to list on local and regional stock exchange in order to kind of bring the funders together with the ESG-oriented companies on the ground. And this is a win-win for everybody. So these are just a couple of examples where the project reflect new priorities on everyone's sides.
Absolutely, and that's a very good point about stock exchanges being also key players in shaping the trends in terms of listing requirements, but also companies willingly subjecting themselves to the scrutiny that goes along with being listed on a stock exchange, and therefore sort of voluntarily agreeing to raise their own standards and becoming more open to public scrutiny. Eric, let's move a little further east. Tell us more about what you're seeing in your part of the world, Eastern Europe, Eurasian countries.
Sure, thanks, Anna. And in addition to, let's think about this a little bit differently. Let's think about demand and supply. And a couple of the big sovereign wealth funds over the last several years, the Norwegians, I believe, they're the ones, I think they completely divested from Norilsk nickel in Russia after a large environmental disaster there. And they're instituting, pretty strict environmental standards to match their investment profile. And they've publicly, stated this is our profile, this is what we're looking for, and this is what we expect from the companies that we invest in. So there's a demand for investments that measure these ESG factors. And to the Polish example, the Warsaw Exchange, the EBRD, the only development bank with democracy in its mission, it recently initiated a project with the Warsaw Stock Exchange to set up a group of standards, ESG standards, of which there are very many, but to kind of consolidate this on the Warsaw Exchange. And have that be a feature of the Warsaw Exchange. So when funds come in to look either to purchase via ETF or other investment vehicle, the ESG Warsaw portfolio, that there was a ready-made product for them. Looking further east, CIPE has been involved in Ukraine for some time, developing a registry of independent directors, because under legislation passed about 4 years ago now, state enterprises had to have qualified independent directors on the board. However, there is no registry or no ready supply of those qualified independent directors that understood the rights, responsibilities, and roles of a director on a board. And so CIPE has worked with several partners in Ukraine, including the Corporate Governance Professionals Association, to create the supply of those partners, of those qualified directors. And we see as European investors move into the East, we see a greater attention on investment in places like Ukraine, that they might not necessarily be labeled ESG investments, but they have an impact in the ESG space. The purchase in Kryvyi Rih in Eastern Ukraine by Aslator Metal of a large steel factory there has led to $4 billion of more investment in environmental controls. That's new coke producers, a new coke processing facility that reduces energy consumption, that increases or decreases rather the environmental impact of the steel manufacturing. At the same time, they're improving labor standards and the treatment of their employees, providing them with additional healthcare outside of the state system, but a private healthcare plan, and raising salaries across the board to be among the highest. I think it's 3 or 4 times the national average salary. So while that's not necessarily an ESG investment, what we see is that investors that are making commitments in places like Ukraine and like Moldova and elsewhere further east, that they're bringing with them values of long-term value creation, which means investing in those facilities in their long-term growth.
Great, and I think you also touched a very important point that sometimes the ESG label may or may not be necessary for an investment or for certain focus for a company to have that de facto event. I mean, I'm thinking in many countries where we work, actually the entry point of the conversation about ESG issues is actually on the G side and sort of close to the basics of corporate governance, because we're talking about countries with the traditions of state ownership, privatization, where often the concepts of corporate governance were still fairly new. Could you talk a little bit about what CIPE is doing on corporate governance, and maybe if you wish, expand a little bit more sort of on our constructive capital views and sort of what countries and companies within those countries in Central and Eastern Europe can do to be more attractive destinations for responsible investment?
Yeah, so part of that work includes creation of registries like this. It includes working with local civil society organizations, business civil society organizations like the American Chambers of Commerce, European Business Associations, to create networks among these players. CIPE's mission is to develop democracy via market-oriented reform. This is what happens between elections. This is the technical process of how rules and regulations are created. While that's not very catchy or you're not going to read about it on the front page of the Financial Times usually. It is the process of compromise, of dialogue between the private sector and the government, each realizing their own responsibility and roles in this process. And where CIPE's role, where investors' role are in Central and Eastern Europe in particular, is to establish those channels of dialogue, of transparent dialogue, where you have two sides talking in the same language. And so sometimes we have to act as a little bit of a translator between what the government says it wants and what private industry or private investors can actually deliver. And part of that process is engaging with these independent associations and these independent organizations to be the translators and the facilitators, the handholders of this process as rule of law catches up with the facts on the ground. A lot of these economies in Central and Eastern Europe have a relatively young code of legal process, and they're just establishing their own business cultures. What does it mean to be a Czech business? What does it mean to be a Polish business? And how is that different? How do we conduct business and ourselves differently from businesses in France or businesses in the UK or the US for that matter? Part of that comes from building a culture, and the culture is built by these institutions. We as an organization, as CIPE, we can really focus only on the private sector. I'm a big believer in focusing on what you have control over and not focusing on what you can control. So what we can control in the private sector is our own conduct, right? It's how we commit ourselves and how we conduct ourselves and the relationships that we build with other private sector actors via supply chain, via industry-wide agreement on a set of standards. And so we, as the private sector, can agree to those standards. I can't control whether a judge is corrupt or not, but I can sure as heck control that my internal compliance is up to date, and I know what's going on inside of my own company, and then I'm helping the whole business community around me set the bar a bit higher.
Great, and let me just quickly post in the chat a link to an article that you wrote a while ago that goes deeper into those topics of what it takes to have this, to help build this constructive environment for ESG and otherwise responsible investments, where you talk about issues of corporate governance, business culture, associations, compliance, and so on. All right. Again, just a reminder to our participants, feel free at any point to put your questions in the Q&A, and we will get to them. In the meantime, let's take another round. So Monique, back to you. Another question I had based on what you said is, so you talked about this balance between regulation when it comes to ESG, and of course, that can be a fairly good incentive, and then voluntary, comply or explain type of approach. I wonder if you could give us some examples in Europe or somewhere else where you think that balance has been working pretty well. And as somebody from Eastern Europe originally, my thought on that is, in those countries, there is a historical legacy of dealing with, authoritarian states where sort of the state is the enemy. So if you give me a regulation, I'll come up with 5 ways to get around that regulation. So in those places, the pure focus on regulation may or may not be effective, just because the enforcement may not quite be there, compliance may not quite be there. So are there some examples that you can think of other countries that this region should be looking at in terms of having a good balance between regulation and other incentives for ESG?
Yeah, so I'll take another example because it's practical, but just to start off with, I know from working that prevention is much better than cure, and it's extremely difficult to backtrack if you don't have proper compliance arrangements in place and something goes wrong. And it can be very costly, in fact, so much costlier than just sorting it out and investing properly at the time. And I think, to Eric's point, that internal compliance in the corporate sector will grow massively over the next 10 years. But in the UK, as an example, we have something called the Modern Slavery Act. And that is that companies have to have policies and procedures to prevent modern slavery in any way. And there was this company that was going to buy fish from Thailand. And they said, we have a policy, and here is our policy. Please confirm that you adhere to this policy. So they got a confirmation back stamped by the government that they had policies in place at their end. And then they hired some investigators because they weren't they didn't disbelieve the company, but they just thought, let's try to go one step further. And it turned out that there were Burmese fishermen caged in these big vessels outside the Thai coast fishing, and of course in complete contravention with the Modern Slavery Act, and hence this contract couldn't go through. And I think that it is measures like that that will set that is an extreme measure, I know, but it's measures like that that will set the world on a good course. And I think about that when I go into companies in the UK where the clothes are super cheap, and I think, where do they come from, and who is providing the funding to these, and are we doing that? So questions like that, but perhaps it is in the nature of someone who is senior. I'm not saying that I'm senior, I'm just saying that it's the nature of what I do. It makes me think like that. But I think that is permeating into organizations everywhere now, and that will change the course and behavior of a lot of things. Because how can you produce t-shirts for £2 and have them flown from, I don't know, somewhere in the East all the way to London and sell them on the streets? It doesn't work. It takes 15 liters of water to produce a t-shirt. So I think that type of thinking has to come through much more. And that, to your point, Eric, internal compliance in the corporates will potentially explode, is my view.
Yes, and that takes us back to what you mentioned with you as a consumer becoming more conscious of what type of considerations should I be applying when I choose what to buy or what not to buy. Monique, what you said also brings us into a related and vast space of risks, ESG risks in the supply chains, right? So the company, the headquarters may have a policy forbidding child labor, human slavery, but things get much more dicey the farther down you go into the supply chain. So do you have thoughts on how companies can better ensure that commitments they make at the top are actually implemented all the way down the supply chain?
Do you want me to answer?
Sure, go ahead. And I mean, anybody
wait, I'll hand over to Eric or Effie. But I just want to say that I think that the example about the fishermen and actually doing a due diligence inspection goes a really long way. So testing the waters and testing that those policies hold water, I think, is important. Not just believing everybody along the chain, that everybody is ethical and saying the right thing along the chain. And we know that companies that have had enormous fine for ABC breaches, anti-bribery and corruption, I'm sure that we all go through training on ABC controls and that people shouldn't bribe and so on, and still it happens. And big banks like Standard Chartered, and not even because they felt foul of actual bribery, but it was their policies and procedures that perhaps should have been better implemented. Testing and training and awareness should have been at the forefront of their internal control system. So I think that things like that, due diligence, I think will form, independent due diligence will form a greater part of our story going forward.
I think the point about how companies actually operate, and this is part of their risk management profile, it's a key here. Because going back to Eric's point about the difference between the private sector and the public sector, and for example the fact that CIPE focuses mainly on the private sector, many new investors in the market, the public investors I mentioned before, and related entities can really fill the gap there, because they work closely with the central bank, with the Ministry of Finance, with other ministries, and be kind of the liaison between the private sector and the public sectors. When you have issues like supply chain risk, etc., they can be a great liaison there. And in many respects, that's really a reflection of how sovereign financial institutions, public investors, how they're changing the way they manage their own risk and how they get involved in the ESG story. So for example, if you look at the market today, there are many, many different ways how they think about ESG strategies and risk management. So for example, the Norwegian fund was mentioned before. For many of them, this is about sectors which are excluded or divestment of certain companies. I think last year, which was really a phenomenon, they divested about 42 companies. And this is, of course, dramatic for the market. But having said that, there are so many other ways of doing it. So for example, the biggest trend now is using the board seat in order to be more active and use these kind of public sector characteristic in order to influence the way companies actually operate, for example, supply chain management and other related risks. So in many ways, the challenges for the industries are the opportunities. The fact that last year you had only 4 funds out of 30 major ones reporting full reports to the market about those kind of risks. One way to think about it is, you know, only 4, but at the same time, it means that all the rest probably going to join over the next couple of years, and we will see many of them sitting on so many boards of companies, changing the way companies operate. Another thing is that for many of them, it used to be only governance out of the ESG, because governance, it's easier to understand, as Monique mentioned before, whether it's a board composition, etc., bylaws. But the reality is that they are now willing to take certain risks themselves and to understand a little bit more what is the S, what is the G, what is the E, and to start and quantify risk, which was very hard for them before. And I just finalize by saying that at the end of the day, I'm sure there will be a balance between how regulators think about it and how these new investors and companies operate, in the sense that if we see, for example, now in Germany or France, new guidelines which are a little bit more binding, trying to change this non-binding environment, very soft approach to ESG strategies, I'm sure that more and more countries will follow the French or German model, whether it's on environmental requirements or others, in order to change the way companies operate on one side and then the way they manage their risk management and financial performance on the other side.
Thank you so much. Eric, your thoughts on ESG and supply chains, specifically in Eastern Europe, Eurasia?
Yeah, so, you know, if I'm sitting in Kiev or in Warsaw, and ESG or sustainable investing and due diligence and compliance are issues that keep bubbling to the surface. From my perspective, as a small business sitting in Central and Eastern Europe, you know, I see here an opportunity. There's been so much outsourcing to Southeast Asia. And what we see now, especially in light of COVID, is this reshoring or reorientation of supply chains. And as a small business sitting in Poland or sitting in Ukraine, I have an opportunity here to make my value proposition. Not only am I going to provide you a product or a service that is equal to or better than what you can currently get. Also, you know, I'm an hour and a half flight away from Frankfurt. So you can come and your compliance officer can come inspect my facilities, take a firsthand look at my production facilities, about where people are receiving the calls, how I'm saving paperwork, you know, and then fly home that night, and she can be home with her family the same day. So from a logistical perspective, practically how things work, you know, Central and Eastern Europe has an opportunity to steal a bit of Southeast Asia's thunder. You know, we saw some of this already with investments right on the border when Ukraine signed the Ukraine Free Trade Act, or the Deep and Comprehensive FTA with the EU, where a lot of businesses relocated, including a major supplier to the the Nestle coffee machines, and I think it's an Austrian company, Fischer, that makes skis. So they're located, you know, right across the border in Ukraine. Their production facilities are there, and these companies that are located in the EU can come inspect. They have a level of confidence in their supply chain that, you know, slave labor is not being used. that compliance is that they're complying with labor standards, complying with environmental standards at or above what are being set by the government, and being a good corporate citizen in that. So there's definitely a big opportunity here. We actually funded or supported the Center for Economic Strategy in Kiev, something called China on the Dnieper, for a pitch for Ukraine to be a major source of manufacturing supply for the EU rather than Southeast Asia.
So shortening the supply chain brings us to the topic that we would be remiss not to address on a Zoom webinar happening during lockdown, and that topic is COVID and the impact of COVID on ESG trends. And Monique, you already touched upon it in your opening remarks a little bit when you said that there is greater, partially due to COVID, there is greater attention to ESG. At the same time, because of our financial pressures, it may be harder in many ways. So you sort of asked the question: will it last after COVID, or will we get back to some kind of business as usual, whatever it meant prior to the pandemic? Could you expand your thoughts on that a little bit, and then I'll direct the same question also to Effie and Eric.
Yeah, so I remember I stopped on saying last time that prevention is better than cure, and I know that the regulators have this at the forefront of their thinking, and once they start raising an issue like that, they raise it and they expect you to follow, and then they raise it again and they expect you to follow, and if you don't do what they expect, they fine, and that's just how they are. So I have a feeling that inspection visits in the future, particularly into the banks, but potentially also to the large asset managers by the regulatory bodies around Europe, will focus greatly on ESG and compliance with their expectations around ESG. And we've now had some time to think about it during COVID. So I would be surprised if it doesn't raise to the agenda much quicker than it would have otherwise. And I think in that regard, I just hope we don't all revert to type. I hope we've taken some of this horrible year and reflected on issues, particularly around the environment. Clearly, all the plastic that we're generating is not great, so we have to have a good rethink about that. But I think carbon neutrality, for example, by particularly the banks, is important because, like we said, they're little countries. So what they do, everybody looks at, and I think that the regulators will expect them to behave and to invest in ESG standards. So for me, I think we're on a pretty good trajectory. At least I hope so. But my glass is always half full.
I think that Monique's point about the acceleration of trends and the fact that the ESG is not only hype, because obviously now, especially in the context of Europe, everybody is trying to understand what it means and how to act on it. I totally agree that it's not only hype, but it's actually here to stay. But I would like to suggest that there are certain parts of the market that were a little bit hidden. And COVID not only accelerated the ESG discussion, but also raised real new issues, which are, of course, connected to the ESG universe, that post-COVID, we will take it a little bit more seriously. I'll just give one or two quick examples, and then I'll let Eric to add on his side. So, for example, biotech investing. So for a long time, for many, many private investors and public investors like pension funds and others, the whole biotech universe was considered very risky, was considered very, very off the chart, things that they didn't want to touch. And if at all, it was a very small part of the alternative investment universe as part of their portfolio. Now, if you look at what's going on in the world, it's quite stunning to see that so many sovereign investors, public pension funds, of course, private investment vehicles are looking into new ways how to invest in biotech, pharma, medical device, etc. Why? Not only because they realize that these areas were underinvested pre-COVID, and that's why we ended up where we are, but also because this is a great fit in terms of their portfolio management and in terms of the future of diversification and the future of ESG investment. Another related example is medical device. Unfortunately, startups in the medical device universe, they know how hard it is to raise money, whether it's a new MRI machine or another e-health related device. So I think that's going to change. And then finally, with respect to working remotely, which is another aspect of our new lifestyle, there are various ESG components related to working remotely. And I think the public investors that I mentioned before are now, for the first time, looking into investing more and more in things like enterprise software and things that are going to make it much easier for people to execute and work remotely. And that brings to the table minorities and other groups which unfortunately couldn't do it all before COVID, and now they would like to be able to work remotely, but at the same time to provide for their families and to get other things done. So these are just a couple of examples how COVID not only accelerated trends, but also created new ESG opportunities in the post-COVID era.
Just to spring off some of those excellent points. So what you've seen, especially in particular types of capital sources, so venture capital, private equity, is extreme concentration in certain geographic areas. And I think that, working remotely, the focus on biotech, which is not traditionally, and medical devices, which is not traditionally a Silicon Valley type of investment product. What you see is kind of investors searching out there, looking for other opportunities, and what working from home and kind of the shift to online working has done. I think it's made it easier for certain startups and certain businesses to make their pitch, to get some attention, and to get a little bit of face time, even if it's via a computer screen. All this is for the good. Over concentration, be it in your portfolio or be it in your diet, is never a good thing. It leads to a malinvestment or heart disease, one or the other. And where we're seeing kind of a massive shift where on current trend lines, these type of events or these type of impact would be seen after a decade. We're seeing it after 6 months or a year. And so you see some of those trend lines earlier that were emerging, and we just kind of fast forward through this COVID period. And it's quite frankly, it's very interesting to pick up on a question here in the chat box. I know we're running out of time. The extraterritoriality of FCPA and ABC legislation, and move that into to environmental or social standards. I think that the EU here, with its proposition of green tariffs and its recent overtures to the United States to kind of create a comprehensive framework for carbon, is a trend that we'll be seeing more of in the future. And that would be, even if the EU goes it alone, it's a very large $19 trillion economy, 500 million consumers. It's going to have a major impact on world allocation of how things are made and where they're produced. So that's one way that through these tariffs, how the extraterritoriality might impact us down the road.
Great. And yes, we are getting some questions in the chat. So let's see if we can address them in our remaining couple of minutes. So Eric, you already started talking about the first one, the first question on the potential for extraterritorial laws. I wonder, Monique, if you want to comment on that. I presume that question came in relation to what you were discussing about the Modern Slavery Act, which is extraterritorial as well. I think there's some debate whether, does it have enough teeth I guess my only comment, it always comes down to implementation. I mean, FCPA has been on the books since 1977. It hasn't really made much impact until the US and other key jurisdictions became more serious about actually bringing up cases. So Monique, do you have any other thoughts on those extraterritorial laws expanding into ESG space?
Yeah, I remember in 2001, or Arthur Levitt, I don't know if anybody remembers him, but that goes to show my age, he used to be the chairman of the SEC, and he wrote in the Wall Street Journal, do you really think that all the bad things happen on this side of the Atlantic? And he had a point. And that is that why does the US always have to lead the way in terms of, implementing these laws that are so important for the rest of the world? We just have to look at Narcos on television to realize that that's not the way we want to live at all. So I think that I do think that the other countries have a huge responsibility to help a little here, and it is important. I know that the UK is trying, and we did a global enforcement review recently, which showed that for AML fines, the US was leading the way for years and years and years, and that trend has actually reversed now, and there's a lot more fine elsewhere in the world, which is a good sign, because it's a sign that shows that we're taking this seriously. And the same should go for what we call ABC, but you call FCPA. And I do think that it should be pushed out to other industries than just financial services too. And I think that other industries need to take this seriously. For example, real estate agents, they have a huge responsibility when it comes to, AML controls and KYC and KYB and so on. And that's a global phenomenon. So we have, as global citizens, I think we have a responsibility everywhere, really.
I will just add, and connecting to a couple of questions and great points that the audience raised about harmonization versus fragmentation, and also overregulation, and the feel that it's going to be so difficult to comply with all these new ESG reporting requirements that people just going to give up or will find it very, very pricey and move to other markets. And I think we saw the same issue after the financial crisis of 2008 and your rules, and same with the SOX regulation in the United States. And here I think there is a major difference, which is the previous regulation waves, it was more like top-down strategy, where one or two major players in the world economy realized that they have to impose certain rules to get to better economic results. Here is a truly bottom-up strategy. Many companies realize that in order to work better with the various stakeholders, customers, suppliers, the nations at large, media platforms, they really have to change the way they operate. So they don't think about it as another nation from the other side of the world trying to impose rules which do not necessarily apply and relevant to their kind of cultural point of reference. So I think, and here I want to conclude, that I think that over the next couple of months and years, we will see, because of this bottom-up strategy, more and more nations feel a little bit more comfortable either adopting their own national rules or talking about harmonization, partnering with multilateral institutions in order to agree on international reporting requirements.
Thank you so much. Eric, you get the last word, and you get to choose. I think we have two more, either your thoughts on any of the questions raised so far, or we have one specifically on sort of the balance between overregulation and not suppressing the entrepreneurial spirit, and then back to standards. So, what standards or whose standards are institutions like the UN advancing as per composition of relevant committees and bodies maybe shifting?
Well, look, the UN is definitely plays a role here, but at the end, there's definitely I believe a large role for nation states to play. They're still the enforcers of the law. They have the judicial systems, and at the end of the day, there's an opportunity, and to Effie's point about matching supply and demand in terms of regulation and setting standards. I'm trying to catch all of these questions in one. As liberal democracies, liberal market-oriented democracies, not just Western countries, but Japan and South Korea, included in this group, there's a drive here to have a common set of standards that make it easy to facilitate business across borders. And this is what we've seen, over the past, 60 plus years. And globalization isn't going to go away tomorrow. But what I do think is that there's going to be more talk about issues like that keyword again that we keep hearing, resilience and sustainability, and what is the best way to achieve resilience and sustainability. From CIPE's perspective, it's pretty obvious, is that you need a democratic rules-based system in order to enforce those market regulations or those market rules, and to maintain an equal playing field so that private sector can go out there and make its best pitch and to compete on that field. And I think that we have a role here in facilitating that discussion, and that it's going to come down to values and culture, those squishy topics that folks in finance don't really like to talk about, but actually at the end of the day really drive value creation. Thank you.
Great, thank you so much. With that, unfortunately, we are out of time, but fear not, our CIPE Duff Phelps event series on ESG issues will continue. So if you didn't get to ask your question this time, please join us again after the new year. We'll be sure to schedule part 3. And we look forward to continuing this conversation. Please join me in thanking our panelists today, and have a wonderful day, everybody.
Thank you very much, Anna, Effie, and Eric. Thank you. Take care.
Thank you. It was terrific.
Bye.
Have a great day, everybody.
Bye.
Thank you. See you.